Hello again. This is Professor Marsh, and today this is a special lecture to prepare you for your final exam. What I'm going to do is I'm going to show you in Excel how to create and to use an amortization schedule. So this builds on the material that we studied in Chapter 13 on long-term liabilities and Section 13.2. And when you're out there applying for a job someday and you're talking about what you know about accounting, in addition to knowing the comprehensive accounting cycle, how to make the journal entries, the T accounts, and to prepare the adjusting and closing entries and prepare the basic financial statements, if someone ever asks you, can you calculate and can you prepare an amortization schedule, you'll be able to say, well, yes, I can. So with that, let's go ahead and take a look at Chapter 13.2. And what I've done is I've set it up so that we can perhaps look at it together on the computer. Not sure if you can read that, but as you can see, I've got Chapter 13.2 and Figure 13.7 up on my screen right now. And you can see in Figure 13.7 that we have a simple amortization schedule. The one that we're actually going to calculate on the computer is going to be even simpler than this. But for today's purposes, let's go ahead and take a look at this. And you can see that this is a loan. It's a 5-year loan at 12% annual interest. And it tells you to assume that the final payment will be $37.74.99. In order to eliminate the potential rounding error of $1.06, I can get a lot closer than that in my example. But in any event, with the $10,000 beginning balance, in year one, you begin the year with $10,000 owed. You make a payment, and this assumes that you make the payment on the last day of each year. The payment we calculate, and we'll talk about how to calculate the payment in Excel, of $2773.93. That's interest of $1,200. How did we calculate the interest? Well, we multiplied the 12% annual interest rate times the beginning balance. We made the payment on the last day of the year. So for the year, it was $1,200 in interest, 12% of $10,000. And so the amount that is credited against principal, the amount that you've paid down in principal with that payment, is $1,573.93. And then at the end of the first year, you have a remaining balance of $8,026.07. How did we calculate that? Well, that's the principal amount subtracted from the beginning balance. So $10,000 minus $1,573.93 gives you $8,426.07. Go ahead and take a pencil and paper to it if you don't believe me, but it works. And then that ending balance at the end of year one becomes the beginning balance at the beginning of year two. And what you can see is we do the same thing. We have the same payment for the next year. Now this time the interest is less. Why is the interest less? Because now we're multiplying the 12% annual interest rate times a smaller number. And again, we're paying on the last day of the year. So 12% times 8,426.07 is $1,011.13. So that's the amount of our interest payment. Our principal payment is the full payment minus the interest. So we're paying down $1,762.80 in principal, and we have an ending balance of $6,663.27. That's the end of year two. We go on to year three. We do the same thing. We have a smaller amount of interest, larger amount of principal. The ending balance goes down to this amount. That becomes the beginning balance for year four. We make the fourth year's payment, even less interest, even more principal. That's the ending balance. And then we get to the fifth year. We have $2,477.67. The amount of interest is this amount. You add it to that, and you make the payment, and you end up with an ending balance of $0 at the end of the loan. You've paid off your loan with those 5 equal payments, and that's what's called the effective interest method of amortization of a loan balance. You're having the same interest rate applied to the outstanding principal in each year. So this is a very important concept. This is how almost all commercial loans are calculated, and you'll see this over and over and over again in your career. And if you can prepare this sort of a amortization schedule yourself, then you'll be ahead of the game. So I'm going to, if I can, move back. Hopefully you can still see the screen. If you can't, then you'll just know that I'm manipulating it on the computer. I'm going to do kind of a simple example. And so let's call this an amortization schedule. I hope you can read this. I know with the glare sometimes in my office it's difficult. Amortization schedule. So I'm now in Excel, and I think all of you have Excel on your computer, and we're going to set this up, and let's go ahead and put in the terms of our loan. Now the first thing I want to do is I want to set up this amortization schedule and make sure that we're dealing with dollars. So I'm just going to format this so everything is dollars. Everything will be dollars and cents and that sort of thing. So we'll have it in the correct currency. And I'm going to make my worksheet a little bit bigger, so hopefully it'll be easier to understand. And maybe I'll even we'll make this bold and capitalize it. Amortization schedule. Not sure why that worked that way, but we'll underline that too. There we go. Okay. Amortization schedule. So what were our terms? What are our parameters? So we're going to have to calculate a payment. And so what do we need to know? Well, we need to know the principal amount. Oh, and that row is not quite wide enough. So let's widen it a little bit, and we can do that up here. Okay, so that's the principal amount, and let's make that 20,000. There we go, and it appears to be properly formatted. Wait, it doesn't have the pennies on it, so we want to have the pennies on it. So let's do that. And then let's see, what's our interest rate going to be? Okay, so the interest rate, let's make the interest rate 6%. Interest rates are a lot less. Oops, that's not a percent. There we go. So interest rate is 6%, and let's make the term 3 years. So it'll be a 3-year loan. And we don't want that. That's let's get the formatting just the way it needs to be, and we don't want that. So there we go, 3 years. Okay. So those are our basic parameters, and now we're going to calculate our payment. Now in Excel, the way that you calculate a payment is you use a formula, and the formula is at PMT, and if you enter that, it'll say it calculates the payment for a loan based on constant payments and a constant interest rate. Well, constant payments and a constant interest rate, that's the effective interest method. And what they ask you to enter is the interest rate, and the interest rate is this right here. And then you put a comma, and then you put in the term, and the term is this, 3 years, and then you put a comma, and then what they call the present value, that's the beginning principal amount. You put that in there, and it calculates a payment for you, and hopefully that's the correct payment. And you'll see it calculates the payment as a negative number. So the idea is that you have the loan has a current balance that's a positive number, and the payment is a negative against that. So let's see if that works to amortize our loan. So let's go ahead and create our amortization schedule. And so over here I'm going to put the word year, and I'm going to put in year 1. Oh, and it's giving me dollars again, so I over formatted. So let's just make that a comma, and let's get rid of the decimals. Okay, so we have year 1, and then in the next year we have year 1 plus another, and that'll give us year 2, and then year 3. We'll just copy that and see if it gives us year 3. And it does. Okay, so we got years 1, 2, and 3. Now let's make the format a little nicer for that. So we'll center it. Yeah, we'll center it. There we go. And let's underline that. And let's see if we can get these guys to center. They don't seem to want to center. Well, okay. All right. Let's start here with the beginning balance. So the beginning balance, and in year 1 our beginning balance is $20,000. So let's go up and grab that. We're going to put that down in there, and that'll give us our beginning balance, and we can kind of clean this up a little bit and format it a little, and we'll underline it just to make it look all pretty, and then we'll go on to the next. And now I'm going to make my amortization schedule a little different. I'm going to calculate the interest first. So I'm putting in interest in here. And how do I calculate the interest? Well, I take the beginning balance and I'm going to multiply it using the asterisk by the interest rate. And that will give us the amount of interest we're paying. Okay, so that's $1,200 in interest, and if you do the math, you'll see that 6% of $20,000 is $1,200. Okay, so how much is the principal payment? So the principal payment, we'll format this. The principal payment is going to be, I'm going to use a minus sign because I've got a negative number when I calculated my payment. So principal payment minus that, so that's the full payment. Okay, so $7,482.20 if I multiply that by -1, right? So that's, and then I'm going to subtract the interest payment, and that should give us the amount of the principal paid out, and then that in turn should allow us to calculate the ending balance by taking the beginning balance and subtracting the principal payment. So let's see if that works. We'll center that, we'll underline that, and we'll take plus beginning balance minus principal, and that gives us the ending balance. And that looks like it's probably going to work pretty well. Okay, so that's our ending balance. And then what are we going to do? We're going to make that the beginning balance in the next year. So I'm just making sure that the worksheet copies that ending balance as the beginning balance in the next year. And then what am I going to do? Well, let's say we just want to copy everything from year 1 and put it down in year 2. And if we do that, we get some really weird numbers. And the reason that we do is we didn't fix our formulas. So let's go back to the formula we had here. So if you look up here, and it's kind of hard to see. Let me get rid of this mess. So let's just get rid of that. If you look up here in interest, I multiplied B9, which is this cell, right? See it right there, times B4. Well, when I come down here to year 2, I want to multiply B10 also by B4, the interest rate. if I multiply B10 by the cell which is the same number of cells that 6% was above 20,000, I'm going to get 13,717 times 3. See, if I copy that and I put it down there and paste it, I get 3 times 7, which, 300%. I don't want 300% interest. That's too expensive a loan for me. So let's delete that. And let's make sure that every time we look for the interest rate, we just pick the interest rate on the loan. So I'm going to fix my cell by inserting these dollar signs. And what these dollar signs do in your formula is they make sure that every time you do an interest calculation and you're using this formula, it's going to go find the 6%. It's not going to look for whatever is also in column B, but the same number of cells up above. So let's try this again. So now we're going to copy this and we're going to put it down here, and let's see what we get. Well, now that number looks a lot more reasonable. And if you do the calculation, you're going to find that this number right here, 823.07, is 6% of 13,717.80. So that's the correct amount of interest. Now, our principal calculation, that was just B6, the payment, subtracted from B9. Okay, so what happens with the principal payment? Well, that's, if we just copy it and we put it down here, we're going to get a crazy number too, because we've searched, instead of subtracting that number from that number, we're subtracting, we're getting a really weird thing. So in any event, what I'm going to do is I'm going to take, I'm going to have to fix the payment as well. So let's delete that. And okay, so here what we want to do is we want to take this full payment to calculate the principal in year 2. We know that we're going to make the same payment again. We just want to subtract this amount of interest. So in order to do that, what we have to do is we have to fix the payment. So our payment is B6. So we're going to make sure every time we look for the payment that we pick the payment that we calculated with the payment formula. So now if we take this number and copy it, so let's take this cell and we copy it down here and paste it. Now we get the correct payment. See how the payment's gone up by the same difference that the interest went down. And if you add these two numbers together, you get 74.8220, just the same as these two numbers add together. So you've correctly split the payment into interest and principal. And now we just copy down the ending balance, and that formula should work, and copy OK, and it does, and it subtracts 13,717.80 by 6659.13, and our difference is 7,000, and then that becomes the beginning balance. And now that we've fixed both the interest rate and the payment amount, now we can just copy the whole thing. So we'll just copy this whole line and we'll put it down here, and let's see what happens. And look at that, we zero out. So our ending balance is 0 at the end of 3 years, and we have now properly created an amortization schedule. So that's great, isn't it? That's pretty darn good. So that's a very simple amortization schedule, and that works for a 3-year loan. And you could make it, let's suppose you wanted to buy a house. Let's suppose you wanted to buy a house and you wanted to calculate what your mortgage payment is going to be. And now you can do this online. There's plenty of websites you can go to, but you can do it for yourself too, just knowing how to use this particular worksheet. So I'm going to copy the whole worksheet. See how I went to the corner and clicked on this? Highlights the whole worksheet, and I'm just going to copy it. And now I'm going to create sheet 2. and I'm going to go back to the corner and click on it again, and I'm going to paste the whole worksheet here. Now I'm going to turn this worksheet into an amortization schedule for a 30-year mortgage. And so how am I going to do that? Well, what I'm going to do is I'm going to, let's see, what should I do here? Okay. Let's say that we're going to have a 6% annual interest rate again. So we're going to make it 6% per year. And if it's 6% per year, then what I have to do to my interest rate is I have to take that interest rate, so we're going to do the 6%, and we're going to divide it by 12, and that'll give us our monthly payment. It says 1%, and the reason it says 1% is because it doesn't have enough decimal places. Okay, so 6% a year is 0.5% per month. Okay, so this is going to give us the monthly interest rate. And then 3 years, okay, so it's not a long enough for, let's make it a 30-year mortgage. So let's cut that, let's put that over here, and let's make that 30 years. And so if it's 30 years, then our period is going to be 30 years times 12. So we're going to take the 30 years and we're going to multiply it by 12, and that'll give us 360 periods. And wait a second, that's not a big enough mortgage. Let's make it a $100,000 mortgage. You can't get much of a house for you know, for $30,000 or $20,000 these days. So anyhow, so that's setting up the amortization schedule to be a 30-year mortgage. And you said, well, you've only got 3 periods there. Well, remember how I was able to turn line 2 into line 3, because now that I've got the formulas fixed, now that I've got it fixed so that the interest that is always calculated using this rate, because I fixed the interest rate. See how I've got it fixed here, that it's always going to go to B4 because it's got those dollar signs, $B, $4. That means it's fixed to go find that cell. And the payment is always, when we calculate the principal, the payment's always going to look for the payment that's calculated by you know, this particular cell. So it's always going to look for B6, see, B6, $B, $6. That means it's always going to find this. And so I can just go ahead and take this line right here, and I can copy it all the way out for the entire 30 years of the loan. So we started back on line 9 or 10. Let's take this all the way out to period 360, and that means I'll probably end up on about line 370, and it's taking some time. Hopefully you were absorbing all this as we go further down into the worksheet, and I don't want to go too fast. I don't want to blow past the ending period, at least not too far past it, although I could go all the way into infinity and or to the end of the Excel worksheet. But let's see, we're up almost to 300, and now we're going a little faster. 320, 340, 350, 360, here's 370. So let's paste and let's see what we get. Okay, so now we have pasted line 3, which has all the proper formulas and everything properly fixed, all the way down through 100 payments, 200 payments. Looks like we're amortizing nicely here. The interest rate's getting smaller and smaller, and look at this, we went past by 2. So the 360th payment gets us down to 0, and we're just going to chop off these last 2 lines. We'll delete these, and that's it, and that's your worksheet. So we're going to call this sheet the 3-year loan, and we're going to call this sheet we're going to call it the 30-year mortgage. So if I can just, there we go, 30-year mortgage. Now if you're trying to separate out what's long-term and short-term, it makes it a lot easier. So if you're at the beginning of the loan, you know that these first 12 payments are going to be made, and so at the end of the year, you know, at the end of the 12th payment, your ending balance is going to be $98,771.99. So if you're calculating the short-term portion of the mortgage, you can take $100,000 and subtract $98,771.99, and you get, you know, the current portion of the loan is about $1,228 and a penny, approximately. So that's your short-term portion, and then the long-term portion of the obligation is $98,771.99. That's the amount of principal you're going to pay in the last 29 years of the loan. So I hope that you find this helpful, and please you know, feel free to take this and manipulate it. I'm going to go ahead and upload this form as a worksheet and a resource in your materials. So you'll find it in both the resources in the Wolf Den for this course, and then you'll also find it as a separate assignment, a reading assignment that will be in Unit 14 in the preparation for your final exam. So I hope you find this helpful. Practice this on your own. Feel free to manipulate it, but always save a copy of the one I did in case you screw it up a little bit. This is easy to screw it up, and sometimes it takes some trial and error. But here's your 30-year mortgage. Here's your 3-year loan. You could see that you could easily make this 5 years if you wanted to. I'm not going to change it because I think it's useful, and that you will find it very useful for the final exam. But in any event, if anybody ever asks you, do you know how to do an amortization schedule on Excel, you can say, well, yes, I do. So with that, I'm going to say goodbye for today, and good luck in your studying, and we will talk to you again soon. Thanks a lot. Bye-bye.